In our last video, we talked about how the labor supply curve has a backward bend, which means at some point as wages go up, workers will respond by supplying less labor. Now, there are two issues in the labor market which make the backward bending labor supply curve a bit unrealistic. And one is institutional constraints, and the other is welfare effects. Now, let's take them one at a time. What are institutional constraints? Well, this is a fancy way of saying that your work is a bit rigid in terms of the time you can and cannot work. In other words, you may have an 8 to 5 shift, and if your boss offers you a higher wage, and you could say, well, look, I could work less hours and still maintain my same level of income, and I'll have more leisure time. Your boss may not like that. Your boss may say, hey, look, you got to be here at these specific times. You can't just cut back your hours as you see fit. So that's what we call institutional constraints. The welfare, so by the way, the institutional constraints is an argument against the upward sloping part of the demand curve. The welfare constraints, this is an argument against the upward sloping part of the labor supply curve. This says, what the upward part says is as wages go up, workers respond by working more hours. Well, if the government has some sort of safety net, let's say welfare or food stamps, some sort of income or in-kind income that you get without needing to work, your incentive to work is reduced because some of your basic needs are already taken care of. So, in other words, if wages go up, you may not have an incentive to work more hours if you have other income coming in. Now, the market supply for labor is the total quantity of labor that workers are willing and able to supply. So, in other words, if you add up all of the individual labor supply curves, you get the market supply curve. And the labor supply curve shifts when the determinants of labor supply change. So in other words, when you look at a labor supply curve, labor supply for the entire market, wage and labor work, this is simply showing you how hours worked changes with wages. But there are other things that affect labor supply other than wage. When those other things change, the labor supply curve shifts to the left or to the right. For example, tastes for leisure and income. If people have a greater affinity for leisure, that could shift the labor supply curve to the left. Income and wealth. If you become wealthier, let's say your home prices go up or your stock portfolio increases, that could affect your willingness and ability to work too. Expectations. If you feel that you're going to lose your job soon or the economy may turn down, you may want to work more now to prepare for that coming storm. So that could shift the labor supply curve to the right. And of course, inflation, the prices of goods and services. If prices go up, you may have to work more hours to buy the basic your basic needs, supply of goods and services, right? And of course, taxes. Taxes can have a big incentive on working more or working less. If tax rates go up, that could reduce the incentive of working more hours, and vice versa. So, over time, labor supply curve have shifted leftward. In other words, over time, the labor supply curve, wage, has shifted this way. Why is that? Well, living standards have gone up. You don't have to work as many hours to make ends meet. We have a greater safety net that allows people to work fewer hours because of basic needs being taken care of. And there are just more things to do outside of work, which reduces people's desire to work. So how responsive will workers be to a change in wage has to do with elasticity, right? Elasticity is really a sensitivity analysis. How sensitive are workers to a change in wage? So the elasticity of labor supply is the percentage change in quantity labor supply divided by the percentage change in the wage. Right? This should look very much like the elasticity calculation we discussed earlier in the class. Now, we've talked about labor supply. What about labor demand? Well, in this case, who are the demanders? Well, firms are the demanders of labor, and households / consumers are the suppliers. So in other words, the role of supply and demand has switched. Remember in the product market, we were talking about households were demanders and firms were suppliers. Well, now in the labor market, firms are the demanders and households are the suppliers. So the demand for labor is the quantity of employees are willing and able to hire at alternative wage rates. Now, we say that the labor demand is a derived demand. That's a special type of demand. A derived demand is basically a demand that's derived from the demand of another good. So if the product that you are producing increases in demand, the need for production increases, therefore the need for labor increases. So you can see how the demand for labor is derived from the demand of which you are producing. So this is important because, and this is one of the reasons why the labor market is such an important market when trying to figure out future demand for goods and services, and vice versa. Future demand for goods and services will also determine the demand for labor. So the number of workers hired is not completely dependent upon the demand for the product, right? The quantity of labor demanded also depends upon its price, or in other words, the wage rate. So here it looks like a normal sloping demand curve. Notice how it's sloping downward, right? And that's because when wages go up, the demand for labor goes down, and when wages go down, the demand for labor goes up. This inverse relationship creates this negative slope for the demand curve. Now, we're going to be talking about MPP, marginal physical product. This is another measurement for productivity. Okay? And that's simply the change in output when you hire one more worker. Now, marginal revenue product is based upon your MPP and the price that you charge for the product. So what is the change in revenue when you hire one more worker? That's MRP. And you can look at as their productivity multiplied by the price you charge for that product. So think about this. If you hire the 10th worker and the 10th worker produced 10 units and you charge $2 for each unit, that means that worker generated $20 worth of revenue for the firm. So MRP is the amount of revenue the worker generates for the company. And when you think about it, the MRP sets the upper limit to what an employer will pay the worker. It doesn't make sense to pay the worker more than their MRP because in other words, the cost will be greater than the revenue that the worker generated. But as we discussed in the very first chapter, productivity falls in the short run as you hire more workers, and each additional worker has a smaller share of the other factors of production. Productivity falls, or MPP falls. If MPP falls, that means MRP falls for a worker. And we call this the law of diminishing returns, right? So as we hire more workers, output increases but at a slower rate, which means productivity is falling. We can graph that, right? Here we have total output is increasing at a slower rate, and MRP, productivity, is increasing for a short period of time. Now it's starting to decrease. So as MRP diminishes, so does as MPP diminishes, so does MRP. So here we have units, number of workers, total output, the price charged. Let's say this is a perfectly competitive firm, so it's $2 for every unit that you sell. And we see how revenue is increasing, right? And we see how marginal revenue product is falling. Marginal revenue product is falling because the price charged is not changing. So remember, MRP equals MPP times price. Well, price is not changing as we change output, but MPP is falling, as you can see if you took the change in output as you hire one more worker. So this means MRP is falling as you hire more workers. So the question is, how many workers do you hire? Well, remember we produced a rate of output where MR equals MC. Well, we're going to be looking at something very similar. Instead of MR, we're going to be looking at MRP. Let me look at this. Okay. And instead of MC, we're going to be looking at wage. So the MRP is like the demand curve here for the firm. And here we have the wage rate is kind of like the marginal cost. And we hire where MRP equals wage. That's like saying MR equals MC. And you can see when you hire the very first worker, they generated this much in revenue, $10 revenue. But in terms of cost, they only charged $4. That means this worker contributed to profit. For the second worker, same thing. They generated $10 in revenue and $4 in cost. The third worker, productivity has fallen. So their MRP is only $8, but that's still above the $4 wage. So profits went up, and so on. You keep hiring until you get to the fifth worker. The fifth worker has MRP equals wage. Now, if you hire the sixth worker, the sixth worker's MRP is only $2, but their wage is $4. And so profits actually fell. Now, there's a trade-off between wages and the number of workers hired, right? If the wage rate goes up, fewer workers will be hired because workers are more expensive, so demand falls for workers. So you can see here, if the wage drops from $4 to $2, the number of workers goes from 5 to 6. Well, one way to increase your value to the employer is to raise your productivity, because think about this, your MRP is based upon your productivity, MPP times the price. if your productivity goes up, holding this constant, your MRP goes up, which means you're more attractive to an employer. So to get higher wages without sacrificing jobs, you can increase MRP. So if MRP goes up, you could hire more workers and not hurt the bottom line for the company because each additional worker is more productive. So increased productivity implies that workers can get higher wages without sacrificing jobs or more employment without lowering wages. So let's take a look at this. If we shift the labor demand curve or the MRP curve to the right, you could either hire additional worker or hire the existing workers at a higher wage. So you could hire either 6 workers or you could continue to hire 5 workers but at a higher wage rate. Now, you can see that productivity is a way of measuring competitiveness. The more productive you are, the more attractive you are. And we can look at that in a macro sense. We can look at productivity for a country, and we can see here in mature economies overall, manufacturing productivity growth remained steady in 2014 at 1.3%. And you can see here, historically, this performance wasn't that strong compared to 4.8% on average from 1999 to 2006 and 2.3% from 2007 to 2012. So this means that this 1.3% increase in 2014 is lower than it has been historically. So productivity in many economies has been falling. In the United States, manufacturing productivity growth recovered from a very low 0.7% in 2013, and it doubled to 1.4% in 2014. Now, that's good, although this is still well below the productivity rates prior to the 2008 recession. And you can see productivity over the last 25 years has been very, very volatile, right? This is the annual percent change in productivity. And you could see here in the late 90s, right here, you could see the trend was upward. And so we were getting close to a 4% growth rate in productivity. Then we had the dot-com bubble burst. That's this area right here, this time frame. And then you could see this downward, even though it's volatile, it's got this downward trend. And we've kind of had this very great volatility. Look at this. But this has been kind of a sideways movement ever since. So overall statistics exaggerate the United States productivity advantage over, let's say, European countries. And American firms spending on software is counted as an investment and is contributing to GDP, but in Euro countries, that's counted as an expense and it's excluded for final output, so their GDP wouldn't seem as high. So bottom line is productivity drives value in labor, and this means that if you want to increase your attractiveness in the labor market, you should try to either work in fields that are increasing the value of the product, or you're increasing your ability to produce.